living your best and longest life, beauty to blood work. The glow up is long-term.
Move over. Anti-aging. Well, aging is the new aesthetic. The beauty world is ditching the war on wrinkles for a marathon of health. Brands like Lancome are leading the charge, even hosting a Circle of Longevity pop-up in NYC to teach us that aging is a journey, not a disaster.
Meanwhile, the future looks bright and hydrated, with 2026's hottest longevity-focused skincare and hair care launches already making waves. It's not about looking 20 forever, it's about looking fabulous at 80. Biohacking the clock. If you want to live forever, you might need to check your gut and your calendar. Scientists are buzzing about good gut bacteria that could act as a natural GLP-1 booster. Talk about a multitasking microbiome.
Today, we're talking about a week where mortgage rates didn't just drift upward, they jumped. And the surprising part is what really pushed them. Not a big jobs report, not the Fed, but war tension that whipped financial markets around so fast, lenders had to keep repricing in real time. Yeah, if you've been watching the 30-year fixed, the big headline is that top-tier rates climbed back above 6.5% for the first time in more than a month. And it wasn't a gentle move. It was the kind of spike that makes buyers freeze and refinance shoppers close the tab.
Let's set the scene. Markets wake up to escalating conflict headlines. Reports of Iran allegedly striking a U.S. warship, attacks tied to oil facilities in the UAE, and instantly you can kind of feel what happens next, right?
Oil pops. And once oil is moving up, the inflation alarm starts ringing. Because higher energy prices leak into everything: shipping, manufacturing, basic costs. And bonds hate inflation, because inflation eats the value of fixed payments. So bond prices drop, yields shoot higher, and mortgage rates ride up right along with them. That's the chain reaction that took over this week.
And the bond market wasn't calmly digesting information. It was basically living on war updates. You could almost track rate movements by checking the latest headline. Early in the week, there was this brief moment of hope. Monday started with rates dipping because the market heard about possible peace proposals from Iran. People exhaled. Maybe things cool down.
And then the very next beat of the story, reports come out basically saying, not so fast, no meaningful progress. And whatever calm the market thought it had found just vanished. By Tuesday, rates were up at the highest levels since late March. That's fast. That's everyone update your pricing right now fast.
Lenders were scrambling. When bonds swing that hard, lenders don't have the luxury of waiting it out. They reprice quickly because they're trying not to get caught, offering yesterday's rate in today's market.
What's wild is that even weaker economic news couldn't really counterbalance it. There was softer data, like a weaker ISM manufacturing report, which in another week might have helped rates ease. But when geopolitical risk is driving the bus, the normal economic signals lose a lot of power. War-driven volatility was the story, and it just drowned out everything else.
And speaking of borrowers adapting, down payment assistance is having a moment. Over 20% of FHA borrowers are now using some form of assistance to make the numbers work with high home prices and higher rates. That's a big deal. It tells you affordability is not just a talking point, it's structural. People are piecing together the path to homeownership with every tool available. And it's not only first-time buyers trying to adapt. Seniors are shaping another part of this story: home equity.
New data shows about 40% of people using home equity investment tools are 55 or older. That's massive. It really underscores that for a lot of retirees, home equity isn't just a nice-to-have, it's part of the financial plan.
Exactly. For older homeowners, the house might be the biggest asset they have. So these tools are becoming more central, especially as everyday costs stay high.
All right, let's hit a few quick stories that paint the rest of the landscape. First, a rare phrase in mortgages lately: rate sale.
Chase is running a limited-time mortgage rate discount through May 17th. The discounts range from 5 to 100 basis points, depending on the scenario. So if someone is actively shopping to buy or refinance, it's one of those moments where you at least want to compare offers.
Next story. A corporate deal that didn't land. Two harbors rejected UWM's bid, an offer at $12 per share, citing concerns about financing and credibility.
And the takeaway there is that it doesn't necessarily mean no deal. It means not that deal. The door stays open for a different offer, especially one that's cleaner and more clearly funded.
Now for a twist that's not obvious unless you're deep in housing development: data centers. The AI boom is changing land competition in places like Texas. Data centers want the same thing home builders want, and sometimes even more intensely: land with strong power access. And when these massive projects come in, they can drive up land costs or take key parcels off the table entirely.
So it becomes harder and more expensive for builders to plan new communities, which matters because we already have housing supply problems. AI doesn't just live in the cloud, It lives on real land, near real power lines. Another story that surprised me. A lot of home buyers are stressing about credit scores and down payments more than they need to. A recent survey found over half of potential buyers think they need a much higher credit score and a much bigger down payment than is actually required for many mortgage options.
That's a quiet problem with loud consequences. If people disqualify themselves before they even talk to a lender, they never get accurate guidance. They just sit on the sidelines assuming they can't buy. And finally, a quick note on reverse mortgages. Reverse mortgage-backed securities issuance rose in April, up to about $525 million, even though total loan endorsements dipped a bit. It suggests steady interest and activity in that segment, with capital markets still engaged, even if the month-to-month loan count wobbles. So if we pull it all together, here's the narrative. Mortgage rates popped higher because war headlines shook bonds and pushed oil up, which reignited inflation concerns. Lenders had to react quickly, and the whole industry is continuing to shift from wait for better rates to build a business that survives any rate environment.
Meanwhile, borrowers are adapting, using down payment assistance, exploring home equity strategies in retirement, and at the same time, plenty of people are still misinformed about what it takes to qualify. It's a market where information is almost as valuable as the interest rate.
And if you're out there thinking, should I buy, should I refinance, should I wait? Maybe the real question is, what part of this do you control? Shopping lenders, verifying requirements, understanding assistance programs, comparing offers like that Chase discount, those are tangible moves in a week where global headlines can flip rates overnight, because the volatility may not be over. But being prepared is still a strategy.
Please subscribe at IamHealthyMoney.com. It would mean so much more than you know. I will continue to bring you fascinating subjects with all the research so you don't have to do it all alone. We will learn together, and then wait until the end of each video for a sneak peek into the next research project. Life has its ups and downs, but you're not alone.
From 10 to 110, we're in this together, right here, right now.
We love ya.